Welcome to vTalkInsight, Market Drivers Daily for January 8th, 2026. Geopolitics, artificial intelligence, and oil markets are all moving at once, creating a complex backdrop for portfolios. We will look at how rising tension over Venezuela and Greenland, the evolving AI equity story, and a softer crude tape are intersecting to drive cross-asset pricing. Geopolitical tension has shifted from background noise to a primary market narrative, with several flashpoints breaking at the same time. Negotiations over Venezuelan oil, United States rhetoric around Greenland, and evolving security guarantees for Ukraine are all testing alliances and reshaping how investors think about regional risk premia. Yet so far, the impact is highly uneven across assets. In Venezuela, plans for up to 50 million barrels of crude shipments to the United States under eased sanctions highlight how energy policy and geopolitics are now tightly linked. The deal framework, which includes strong United States oversight and leaves Chevron as the only major Western operator on the ground, is paired with a tougher stance on shadow fleet tankers and even Russian naval escorts for sanctioned cargoes. With global oil still oversupplied, these moves matter less for near-term prices and more for the long-term balance of power in energy trade. Further north, tension over Greenland underscores how strategic minerals and Arctic routes have become part of great power competition. United States' interest in Greenland's rare minerals and military footprint, including public discussion of not ruling out military options, has unnerved Denmark and raised questions about NATO cohesion. Rare earth-related names, such as critical metals, have spiked, with gains of around 30 to 40% in a couple of days, as investors reassess supply security and the risk of more export controls from China. These strains are feeding directly into defense and safe haven assets. European defense stocks across Germany, France, and the United Kingdom are outperforming broader indices, helped by expectations that spending will tilt away from United States suppliers and toward domestic firms, and by a renewed focus on electronic warfare, air defense, and drones. Venture funding into defense technology has surged from under $200 million a decade ago to around $5 billion, while a proposed 50% increase in the United States defense budget to $1.5 trillion signals structural demand, even as political scrutiny of contractors rises. Safe haven flows are also visible in gold and currencies, with gold marking more than 50 all-time highs over the past year, and the United States dollar supported by its role as a geopolitical hedge, particularly against the euro that looks vulnerable if nuclear power tensions escalate. At the same time, overall risk appetite remains resilient, supported by robust United States growth, strong corporate balance sheets, and expectations for Federal Reserve easing, while volatility tends to stay subdued and recoveries from shocks are rapid. Investors are increasingly focused on tail risks such as Taiwan and the possibility of a 5 to 7% pullback as multiple events converge. But for now, the main equity engine remains artificial intelligence, which is where we turn next. Artificial intelligence is still at the heart of the equity story, but the narrative is evolving from a narrow mega-cap trade into a broader, more complex ecosystem. Hardware, memory, industrial automation, and sector-specific applications are taking a larger share of the theme, even as questions grow around the sustainability of capital spending, valuations, and regulation. That mix of strong fundamentals and rising scrutiny is driving greater dispersion across AI-related names. On the investment side, projected technology capital expenditure is expected to grow by roughly 30 to 35% in 2026 before slowing to around 10 to 15% in 2027, suggesting a powerful but maturing build-out phase. Within that, AI is central to corporate strategy. Nearly half of recent technology mergers and acquisitions had an explicit AI angle, and a quarter of would-be buyers walked away because of AI-related risks in target businesses. Mega-cap leaders remain confident, with NVIDIA signaling that strong demand and large custom deals could take revenue above its previous $500 billion target for fiscal 2026, even as peers like AMD see share price setbacks after very strong runs. For the real economy, AI is increasingly about productivity rather than just new products. Corporate margins are projected to expand toward roughly 13.9%, helped by 20 to 40% efficiency gains in some sectors as firms automate back-office tasks and redesign workflows. Companies with high labor costs stand to see the biggest impact, while banks, other financial services, and healthcare are expected to benefit from both efficiency and new revenue streams as AI tools spread across almost every sector of the S&P 500. The supply side of AI infrastructure is also shifting, particularly around memory and storage. High-bandwidth memory producers like SK Hynix and Samsung, along with names such as SanDisk, Western Digital, Micron, and Seagate, have rallied sharply as demand for AI workloads pushes memory prices higher, and some manufacturers plan price hikes of 60 to 70% this quarter. There's a growing view that memory and storage costs will soon exceed compute costs, shifting margin power toward memory makers just as energy supply constraints and rising prices for copper, lithium, and electricity highlight how AI demand is tightening broader commodity markets. Against this strong backdrop, several risks are coming into sharper focus. Retail investors are heavily overweight equities, with margin balances and AI positioning back near prior peaks, raising concerns about froth, while late-stage AI valuations carry clear correction risk if capital expenditure or demand disappoints, and recent evidence shows AI capex is already losing some momentum. Regulators are also paying more attention as worries build over job displacement and energy usage, and geopolitics adds another layer of risk for chip and rare earth supply chains that depend heavily on Taiwan and Chinese exports, all of which makes the cost and availability of power a critical link into the energy complex. Oil markets sit at the intersection of this geopolitical and AI-driven backdrop, with prices under pressure even as political stakes rise. Global crude remains oversupplied, inventories are building, and more barrels are sitting on tankers. Yet headlines around Venezuelan shipments, tighter sanctions enforcement, and election-driven energy policy are keeping the sector firmly in focus. The result is a market that looks comfortable near-term but fragile further out. The immediate catalyst is Venezuela's plan to send around 50 million barrels of oil to the United States, worth roughly $2.8 billion and representing about 50 days of its current production. Sanctions are being selectively eased so that crude can flow to the United States and allies under strict oversight, potentially redirecting barrels that previously went to China and giving refiners, such as Valero and Marathon Petroleum, more access to heavy sour feedstock. Proceeds are slated to support Venezuela's battered infrastructure and population after years of economic collapse, but entrenched military interests and the risk of renewed violence leave any smooth transition, and therefore long-term investment, uncertain. Despite the political drama, the macro oil story remains one of oversupply. Venezuela's output is under 1 million barrels per day in a market that produces over 100 million. Global storage is elevated, and current crude prices around the high 50s are approaching break-even levels that many producers find unattractive, reinforcing capital discipline and reluctance to commit large new projects, especially in unstable jurisdictions. European oil stocks have come under pressure, with names like BP down in recent trading, even as Saudi Arabia has already raised close to $25 billion this year to help fund spending plans amid subdued prices. Enforcement against sanctioned shadow fleets linked to Russia, Iran, and Venezuela is tightening, but with ample supply, markets see limited near-term price impact. For macro investors, lower oil prices create a short-term disinflationary impulse and some support for consumer spending, aligning with political goals to ease cost of living ahead of elections. However, the picture is more nuanced when set against rising prices for copper, lithium, and electricity driven by electrification and AI infrastructure, and by persistent underinvestment in traditional fossil supply constrained by sanctions on Venezuela, Iran, and Russia. Energy availability is also emerging as a critical risk for data centers and AI growth, meaning that even if headline oil prices stay low for now, power pricing and grid investment could become binding constraints. Looking further out, expectations for a rapid recovery in Venezuelan output, such as a 200,000 barrel per day increase, appear optimistic given years of underinvestment and infrastructure decay, and major United States oil companies remain hesitant to deploy the $10 billion or more that would be needed without stronger political guarantees. That leaves a market where near-term supply risk is subdued, but the longer-term balance is vulnerable if demand rebounds or if sanctions tighten again, with potential knock-on effects for inflation, bond yields, and the energy-intensive AI build-out. Key watch points include final terms and enforcement of the Venezuelan deal, OPEC Plus responses, investment plans from the majors, and how refiners, producers, and power markets each adjust as oil, politics, and technology continue to collide. To sum up, markets are juggling heightened geopolitical tension, a powerful but maturing AI investment cycle, and an oil market that looks oversupplied today but underinvested for tomorrow. Defense assets, gold, and the dollar are carrying much of the geopolitical risk premium, while AI-driven productivity and earnings remain central to equity leadership even as bubble concerns grow and supply chains tighten. In energy, Venezuelan barrels and softer crude prices ease near-term inflation pressures but underscore longer-term supply and power constraints, especially for data center growth. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.